Hi there, this is one of my first attempts at a video blog. So I know I typically write these lengthy posts and I email them out to the majority of my clients. But it's a brand new world of video, so I've been told to do some video. So here goes. So let me know what you think. I'm very interested to get the feedback on this. I thought for an opening video I'd tackle the topic of fixed versus variable. It's an age-old debate. Doesn't make any sense to me why we debate this at all. I mean, again, I guess I'm on the inside of the industry, so I understand things a lot better now. But it's variable. Variable wins, period, the end. But let's dig into it. So 2 bets. Right now, there's roughly a 1% advantage. If you're taking a new mortgage, if you're renewing a new mortgage, you're purchasing a property and you're wondering which way to go in this rising rate environment where, rates seem to be going up and variable seems risky. Well, let's talk about the 2 bets you're making, because it isn't one bet. It isn't just interest rate. There's another bet being placed when you go with a fixed mortgage. The first one is the obvious one. It's very easy to discuss. It's the interest expense. And I think it's really easy to determine at the end of this segment which makes the most sense. So if you say to me today you want to take a 5-year fixed mortgage, you're placing a bet. You're placing a bet that the 5-year fix is going to work out cheaper than the variable, because you're worried, understandably. The media does a good job of creating fear. That's what they do. You have a fear of rising rates and you're worried about not being able to afford payments, et cetera, et cetera. One of the key points I would make is that we always strive to have our clients set their variable rate mortgages up with the fixed rate payment. So right now, with that 1% difference, it's a 1% lower rate typically, approximately, but we'll use 1% for our purposes today. You set your payment on that fixed rate, you've basically created a buffer for the next 4 quarter-point Bank of Canada hikes. And the Bank of Canada, 99% of the time, will move in quarter-point interest rate increments. So to take that fixed rate mortgage, you might think the bet you're making is that the Bank of Canada is going to move prime up 4 more times. That's not the bet. That's not the bet. You haven't won. If they move it up 4 more times, well, as long as it took them to do that, I've been saving money in my variable rate mortgage. You've been paying extra in your fixed rate mortgage, so I've got savings. So even when the Bank of Canada moves prime up 4 steps, I still won. So you may think, oh, I see. So actually the bet is that prime needs to go up 5, 6, 7, 8 times. That's actually not even the bet, because even if the Bank of Canada moves prime 5, 6, 7, 8 times, all we've done there is give back the savings. I'm still at even money by the time that 8th hike comes around. So you still haven't won yet. What you're saying to me when you say the 5-year fixed is the safe choice is you're saying you believe the Bank of Canada is going to move prime up 9, 10, 11 times. That's a big jump. That's 2% plus, 2.25%, 2.5% over the next 5 years. But that leads us to the second piece, the side bet that you've made that unfortunately the majority of Canadians don't even know they made. And that's the penalty expense. So in a 5-year fixed mortgage with every chartered bank and nearly every credit union, the penalty math is approximately 4.5% of the balance in a 5-year fixed product. So if you have a $400,000 mortgage, that's an $18,000 prepayment penalty. Now I know you're never going to break your mortgage, but 6 out of 10 Canadians will. I get it, you're going to be in the 4 out of 10. No way you're breaking your mortgage. Yeah, that's what I thought. We've broken mortgages left and right. It happens. And in fact, I'll digress real quick here. The very first property we bought, no sooner had we moved in and lived there for the first year than all of a sudden there was a new 3rd person on the way into our family, and we decided we needed a bigger house. So we sold that house, bought a new house, went to the bank and said, hey, please port our mortgage. And they said, no, the new house is on well water. We don't like that. We're not porting the mortgage. Go get it somewhere else. And by the way, you're going to have to pay this penalty. What penalty? You never told us about a penalty. Nobody talks about the penalty up front. That penalty, as I say, about 4.5% of the balance. It was $6,400 on a $160,000 mortgage. This is 20 years ago, back in the good old days. But we'd put $8,000 down. Like our whole life savings is down on this property at the time, and the bank just kept it and said, well, you can have $1,600 back. There you go. And the market was pretty flat at that time. It wasn't like the property had shot up in value. So it was a pretty depressing conversation. So we rounded up some new down payment money for the other property and closed on the other property. But at that time, I did something nobody does. I bought a 200-page book on mortgages. I read it cover to cover. And by the time I went back to the bank, I knew more than the person at the bank about mortgages. And I went variable when I was 27 years old and never looked back. And I've been variable ever since. One exception, I did one 2-year fixed term on one of our properties briefly because the interest rate was a little lower. The variable rate mortgage in that $400,000 example, for instance, it's 0.5% of the balance penalty. 0.5%, $500 per 100,000 instead of $4,500 per 100,000. That's right. In a fixed rate mortgage, the penalty is 900% larger. It's 9 times larger. So $18,000 penalty on a $400,000 mortgage or a $2,000 penalty. And again, 6 out of 10 Canadians will trigger this. Now, I don't know who exactly I'm talking to. I hope you're not newlyweds and you're sitting there holding hands and you're all in love when I say what I'm going to say. But look, the reality is 6 out of 10 marriages end in divorce. I'm sure you're running a successful business if you're running a business. I'm sure you're working for a successful company if you're working for another company. But the reality is 96% of companies don't last 10 years. So between 96% of companies not existing for 10 years, between 60% of marriages not lasting for 10 years, this is a situation we have. 6 out of 10 people are moving, they're refinancing, they're having to restructure their mortgage for some reason, and they're triggering a penalty nobody told them about. And all they worried about was number one. All they worried about was the fear of an increased interest expense, not even realizing that that fear required 9 hikes from the Bank of Canada to actually make sense. So, as I say, you can tell by now, I'm pretty pro-variable. I mean, you're basically, with number 2 bet here, you're pushing $16,000 on the table in the case of a $400,000 mortgage. That's the difference in penalties. You're pushing $16,000 out there saying, I'm not only is the Bank of Canada going to increase prime 9 times? I believe that's going to happen. So I'm going to make this $16,000 bet that the fixed rate's the one to go in, because I also believe that I'm going to be in the 4 out of 10 that makes it to full term. That's 2 bets that you're making that I wouldn't be comfortable making, and I don't make them. And I hope that you don't make them. And if you want to chat further about it, you know where to reach me. Thanks for your time.